All right, guys, welcome back. We're going to be going over basic liquidity. We covered some of it in the beginning of the video, but now we're going to go a little bit deeper into it. So let's go. All right. So we got equal lows, equal highs. These are pretty much double bottoms and double tops and the retail perspective point of view. And in order for a equal low to be valid, the left should be lower than the right. And for equal highs, the left should be higher than the right. Now there is scenarios where they're perfectly equal, just like that. This is not a equal low, and this is not equal low. This is not a equal high. This is not equal high. Okay, only this one, and of course when they're perfectly together like this, or even, should I say. All right. So we got equal highs, equal lows. We have trend line liquidity. 1, 2, 3. We have very trend line. Most likely 1, 2, 3 touches. That's the average retail number, right, of touches that they're expecting. Then we also have SNR liquidity. So support and resistance levels like that. That becomes liquidity, the liquidity to us. And then obviously we have every high and every low is liquidity. And that's just every structure high and every structure low. All right, this is quite obvious. There's liquidity in every high and every low. If you know what you know, that there's liquidity in every high and every low. So now let's put this into some examples. Right, so we have a low, then we have a high. So strong low, weak high. That's our overall target, right? So price break structure, price goes up, and this point right here was supposed to take out that low. And if that high fails, that's what we call a what? A failure swing, or in other words, a weak high. So price does this, it takes it out. That becomes the inducement. That becomes the inducement. All right. Then price comes into a point of interest right there. And then what did price create? It created equal lows. Now I want you to understand something. Price needs a reason to go somewhere. It needs a reason. So it builds up liquidity. So once that liquidity is built up, it gives price a reason to go there. And that's important to understand. It doesn't just randomly do something. It needs a reason, right? A cause and effect, right? So this is the reason why price came here. Not only that, we also have our range low. So equal lows and range low. And then price takes it out. Then what happens? Pulls back. And let's say this happens, right? And then it cuts into a POI right there. So now what was price doing all of this time while this was going on? It was also creating trend line liquidity. They're expecting a third touch. That's the retail's perspective, expecting a third touch. Right? Not only retail, right? Maybe some other traders, but they're expecting a third touch. So what happens? Price pushes up, takes them out. It gave it a reason to go up. It was building already liquidity above when it was going down. It took out sell stops, sell stops. At the same time, it was building up the buy stops. Right? There's pending orders here. And not only that, you also have the people that have their stop losses up here protected on the swing points, etc. And then what happens? Then price pulls back down. It takes out all the buy stops. So they get triggered, then they get taken. These guys get triggered, then they get taken. Full of manipulation. Look into another example. All right, we have our strong low right there. And then we have push, so a break, just like that. And then we have a push again. All right, and then we have a break. Now again, assuming price came into, took out internal range liquidity, etc. So these are our ranges. That's a range. And then it came into a point of interest right here. All right. And let's say we had internal range liquidity right there. Price came into there, right? And of course, it didn't happen like that. It happened like this, just like that. So range after range, right? And then we fulfilled this overall bigger range. Let's say there's a bigger range. Just color on this from A to B. Target, right? What was it doing? When price was coming down, it was creating liquidity, giving it a reason to go to the upside, to explode. That's why you see those huge candles just come out of nowhere. Like, why is this happening? What's going on? Well, they build up so much liquidity, in other words, compressed it, then shut up. Because they gave it a reason. It was just squeezing, took off. Right there. All right. So yeah, that is pretty much the basic understanding of liquidity. And then let's do now one more example of SNR. All right. So let's say price is this, price pushes up, and then let's say price taps into here. All right, perfectly. All right, and there's internal liquidity. We have that, and then we also have internal liquidity right there. And then price comes down, but fails to take out this low. That now becomes obviously weak. So that becomes weak, obviously. That's also weak. And we have SNR liquidity, and we have internal liquidity above. All of this can happen in one area, and that's just multiple confluences. And then this can happen. Then it can drop. But notice this, when it was going up, it created liquidity. See that? So either way it goes, it needs a reason. It's gonna keep creating liquidity because it needs a reason. So let's say we didn't have this. Now we had was this and it broke. But it never came into a POI. It never came there. And there was no internal liquidity. So because there was no internal liquidity, we couldn't consider this as a POI. So price pushes up and takes this out. Why does it take that out? There's liquidity right there. It's a liquidity right there. And then that creates our range from here to here. That becomes internal liquidity inside the range. Do you see how a structure by itself doesn't work? Because imagine everyone going short here. So once you understand your range and what we need to form it, that's internal liquidity, and you know that. And we also have external liquidity lined up with it perfectly. POI there. And now, because this failed to take out this, because if this was the real price doing the real move, why didn't it just keep going up higher? Right? So what happens? That becomes weak. And that gave it a reason. That gave it a reason to come into here and then continue going up higher. And then again, what happened? It created liquidity. Even more of a reason to go even higher into our external range. Right? Again, all of these are just examples that I've seen happen in the market. Like I mentioned in the beginning, nothing is going to be picture perfect. Nothing is going to be perfect. Obviously, they'll come in different shape and sizes. That's why I mentioned a lot, or I did mention in the first video, that you have to understand the fact nature of the market, because you have to trade what you see, what's kind of going on. Right, but this is an example. This is something that really does happen in the market. It happens over and over. So no matter where you go, and by no matter where you go is, no matter where you enter, let's say, the market needs a reason to go there. Right. So if you entered here, there was a reason why price came here to give the entry. If you entered here, there's a reason why price came here, right, to give you that entry. If you exit here, there's a reason why you exit here. Right? It has to make logical sense. So yeah, this is just basics of liquidity combined with the ranges. So I hope everything's making sense so far. So we covered external liquidity, equal highs, equal lows, trend on liquidity. And that's pretty much it for basic liquidity combined with the ranges itself, right? You notice that there's a reason, there's a cause and effect for everything. There's liquidity everywhere. The market is driven by liquidity. So he'll be fully aware of that. All right. So that's it for this. Like always, any questions, you can let me know. Other than that, moving on to the next one.